All right. Hi, everyone. My name's Janet Davis. I'm with Midland Trust Company. Thank you for joining us today. We have three distinguished guests from the East Coast of Florida who's going to share their perspectives on the state of real estate and their challenges and opportunities. Before I introduce the first guest, I want to tell you a little bit about Midland. So hang on just a second here while I share a couple of slides. We're a self-directed IRA custodian. We also are a qualified intermediary for 1031 exchanges, and we offer private fund custody. Our main offices are in Chicago, Fort Myers, and Sioux Falls. We have over $2 billion in client assets and have over 16,000 account holders around the country. We make no commission. We do not sell investments. We work at your direction to fully administrate the needs and requirements of investments that you choose. We do not give legal, tax, or investment advice, but our offices are operated by individuals with backgrounds in the legal and tax fields. Many of our staff members also have achieved the designation of Certified IRA Services Professional. In 2017, Midland Trust Company was formed as the custodian of Midland IRA Incorporated. Hang on here. All right, the choice is yours. Midland Trust does not give investment advice or endorse any products. All information and material that's going to be presented are for educational purposes only. Please consult with your attorney, accountant, or financial advisors before entering into any type of investment. All right, hang on here. Okay, sorry about that. All right, now if you have any questions for the speakers, please feel free to type them into the questions tab on the right-hand side of your screen. Also, if you have any issues with hearing, you might want to refresh your screen because that does tend to help that situation. I want to start off and introduce our first guest, Ryan Brandenberger. Ryan is the branch manager at Cross Country Mortgage and is ranked in the top 1% of loan originators nationally. Ryan, please talk to us a little bit about what you're seeing in the market from a loan perspective.
Hi, and thank you for inviting me to be part of this panel. And I hope I can provide everybody with some valuable information today about the market, a little bit about mortgages, and hopefully I can answer some questions for you. So thanks again for having me. So it's been a wild ride in the mortgage industry lately, as you've heard, with the COVID-19, the impact on the market. And so today I'd like to talk about some of the changes that you might see when in regards to interest rates, what you can expect from a product standpoint, and most importantly, the process that you're going to go through in order to obtain a mortgage. So I'll start by talking about the interest rates. So interest rates today obviously are very low. We've hit an all-time low. Every month it seems like we're going lower and lower to the historic low, and it has created a huge influx of refinance opportunities for most of the mortgage companies, banks, and mortgage brokers. As great as this is for the mortgage companies themselves, this is also impacting the secondary market and liquidity in the mortgage market. So many people coming to get refinanced has jammed up our mortgage companies, processing departments, underwriting departments, fundings. So as much as it's great news, it's also created some complication. Not only has the influx of refinances put a lot of strain and weight on mortgage companies, so has the secondary market basically eliminating a lot of products that have been that have been common over the last few years. So we've seen a mass influx of refinance opportunities, and we've also seen the jumbo market, the bank statement programs, and some of the more riskier loans that were being provided disappear. So it's been a challenge for some that normally would be able to get approved. And it's been a great opportunity for the ones that, easily get approved. So it's a lot of good things are coming out of this. Obviously, people can move from the interest rates in the 4s down to the 2s, which has been a great thing for homeowners. But it's also put a lot of strain on new homeowners or new home buyers that would like to purchase in this market, because we're seeing a lot of contraction where the products that were available 3 or 4 months ago are not back, or they're gone and they're not back yet. We're hoping to see some of these products come back soon. So, I just want to touch on rates for a little bit. When you're looking at buying a home, an interest rate is definitely something that's important, but it's not the deciding factor when purchasing a home. There's so many other things to be conscious of, right? The condition, location, how long you're going to stay in the property for. But when it comes to refinancing, a lot of people call me and ask me, does it make sense? Does it make sense? And it's a tough question, because the calculator is really what determines what makes sense when it comes to a refinance. It's not really an emotional transaction like a purchase would be. A refinance is all about cost and savings. So if you're in the market now to refinance and you want to break down the difference, or really compare what the costs are and what the savings are, it's important that you go to somebody that you trust. Mortgages should never be sold. Nobody should be trying to sell a mortgage. It's really about structuring it and understanding the person's needs and goals. Because just because you can save $5,000 a month, $5,000 a year in interest, it doesn't always make sense if you're going to spend $8,000 to refinance to save $5,000 a year, and you only plan on being in that property for a couple of years. So there's a lot of factors that have to be weighed out. So I strongly suggest, just like any other financial product that you're interested in, is to make sure you go to somebody that you trust. I'm not going to name any companies, but any company that is advertising refinancing or advertising mortgages, a lot of times you have to be careful of the person that you're calling into, because they're the incentive for a call center type environment is really just about, it's more transactional and not relationship driven. So if you're looking at refinancing, make sure that you're working with somebody that really has an interest in your financial well-being, not just at the transaction, but after you close on the home loan. And that's something that I like to pride myself in, and my team. I have 11 loan officers that work for me. I have 15 people in my operations staff. And, I just try to tell everybody to look at your mortgage, look at somebody else's mortgage as if it's yours. So when I'm looking at a refinance, I want to make sure, people are saying the audio is not good. Are you guys having a hard time with the audio? Can you hear me?
Yeah, we can hear you, but you're kind of cutting in and out just a little bit.
And I have, I hate to, so some are saying yes, they can. So, if I talk louder, does that help, or is it just more?
I think maybe try talking louder. Let's give that a shot.
And there's an echo. Okay, so some are saying okay. And I'm in a room I guess I need more books or something in my room. It's a little hollow, but I'll try to talk louder. So somebody said louder helps. So when looking into doing a refinance, it's really about somebody that you trust. It's not about being sold. The calculator will do the talking for you. If it makes sense, somebody that's in your best interest will help lead you to that refinance. If it doesn't, that person should also tell you not to do it. So it's important that you can find somebody that knows how to say no when in fact, that's the right answer. So refinancing, again, it's a big thing. It's a hot topic. There's a lot of commercials online. A lot of people are jumping into the industry so they can take advantage of this refi boom. Make sure you're working with somebody who's looking out for you. So the 30-year fixed rate, I'll throw some numbers out there. The 30-year fix is close to 3%, 3.125, and the 15-year is it's closer to like 2.75. So it is really, really low. So definitely something you want to look into. I want to go on to products. What's happening with the mortgage products? Products are being limited when it comes to the jumbos, bank statement programs, and the main reason why is the secondary market has froze up and there's just not enough liquidity. So if you were going to get qualified 5-6 months ago as a self-employed individual with a bank statement program, you need to reevaluate and check to see if that program is still available for you, because it may not be there. Every day it's getting better. As I think we can all say in the economy, the numbers when it pertains to COVID, every day it's getting better. I would like to say that we're kind of back on track, within the next 60 days with all available products that were available in the market, say 6 months ago. Last thing I just wanted to touch on was process. So process is something you need to really be careful with, because if you're going in to get a mortgage and you're for a purchase loan, that mortgage process, there's no room for a delay or a flaw. So a lot of mortgage companies are inundated with refinances, which has pretty much where they're having capacity issues, where what used to take 2 to 3 weeks to close a home loan is now taking 4 to 6 weeks. If you're in a contract to buy a home, Florida is pretty common. I know a lot of people here are from Florida. Florida is common to have a 30-day or less close. Make sure the company you're working with can meet that expectations. You don't want your purchase loan to take a backseat to a refinance loan. So most trusted companies that focus on the purchase business are not allowing the refinance business to get in the way. Unfortunately, the bigger banks, they don't really have that type of control on the capacity. So the banks are seeing 45 and 60-day closings, while the smaller, more boutique mortgage companies are still getting away with doing, like I do a 2-week close guarantee. But that's definitely another big issue that we're seeing across the board in the market. And that's pretty much it from a product standpoint, as far as interest rates and process. I'm the branch manager at Cross Country Mortgage in Boca Raton. I've been doing home loans in South Florida for 18 years. We successfully close over 50 transactions a month. And, we do that. We were doing that before COVID. Now we're doing a little bit more, obviously, with the refinance opportunities that are there. So if anyone has any questions, I'm open. Keith, information on the market. So as a mortgage, the market for me is the interest rates, right? That's the market that I control. From a real estate perspective, as far as the market, I'm not a licensed realtor anymore. But if you wanted market information, I would, it's very specific to the geographics. So in pertaining to, Naples is much different than Coral Springs. So I think when you get down into the market, it can go over some general national or state information. But I think our markets are much more geographically pinned into like zip codes and neighborhoods. So I wouldn't have any real general real estate information, except the fact that there's no inventory. We know that in South Florida, we do not see the inventory that we saw a year ago. I think it's 30% decline year over year on inventory. But from a mortgage market standpoint, interest rates are low, products have been limited, and we're really busy in the mortgage side.
There's a question about, do you do cash out refis for investment properties?
Yeah, so where we've seen people limit on the cash out refinances for investment properties, we have not. So mortgages go direct to Fannie Mae, Freddie Mac, FHA, and VA. I lend for all of those sources. So we do not have overlays. So Fannie Mae and Freddie Mac is still cashing out on investment properties. We're still cashing out on investment properties. I have seen the bigger banks pull back on those cash out refinances as they don't have the risk tolerance that a lot of mortgage companies have.
So a couple of questions, and I believe Teresa or Brenda, correct me if I don't have this question right, but people that hold real estate in their self-directed IRAs, they're asking, do you provide any loans? And in that case, I believe the loans would have to be non-recourse loans. Is that something that you all provide as a company?
Yeah, so typically we do not. So that would be something that you would, like, for example, if your money's with Merrill Lynch, they have different lending standards because it's collateralized money. Then, and I just use them as an example because we compete with them. You're going to find better opportunities with your collateral, with going to your investment portfolios and working a deal out with them because they're holding a portfolio. And sometimes they'll cross collateralize that. We are strictly doing agency financing. So it's, again, the Fannie Mae, Freddie Mac, FHA, and VA.
Okay. Another question, are you a portfolio lender? Which you may have somewhat answered just then. So,
well, that's a good question. I mean, do I have portfolio products? Yes, but we're not banking on any products. So most of our portfolio lenders that we use are for our bank statement programs, our foreign nationals. We also have some asset depletion loans. Those loans are actually for, we broker those out, so we do not actually portfolio them.
Okay, very good. I know some people are asking for contact information, and after everyone speaks, I'm going to put up a slide with all the presenters' contact information, their email, and their phone number for you all. And then at the end of this session, you'll receive a recording of the session, which will also have their contact information on it. So hopefully that'll be helpful. Any other questions before we go on? Let me just make sure I got everything. I believe
Janet,
I did.
Did you see the one about portfolio lending?
Yeah, he already answered that.
Yeah, I think I just touched on that.
Yeah,
All right.
Thank you, though. All right, well, thank you very much, Ryan. We appreciate it.
Thank you.
Now we're going to go ahead and introduce Daniel Cunningham. Daniel is the first Vice President of Investments with Marcus and Millsap and specializes in the multifamily market. Daniel, please tell us about some of your challenges and opportunities in today's market.
A lot of the lenders were backing off even properties that were in contract. So just to give you some market stats, COVID, we were collecting in multifamily nationally when you're surveying probably 400,000 to 500,000 units. Our firm does a lot of research. You were looking at in the 80% collecting 80% of the rents. It's moved up a little bit to about 84% of the rents now that lenders are seeing that the multifamily is actually performing. Commercial properties, strip centers, office buildings, those are the ones really having a hard time collecting rents. I mean, we've seen in some markets where they have 70% delinquency in some of those commercial properties. Multifamily is holding really strong. Ryan touched on something of lack of inventory. There is a huge lack of inventory in multifamily properties. A lot of sellers were hesitant to put properties on the market in the middle of the pandemic. You're going to start seeing a flood of inventory hitting the market, I believe, in the next 30, 60, 90 days. So there is going to be a lot of opportunity down here in Florida as far as commercial investment. But it really is tied to several things. Number one, the financing. And the number one thing lenders are really looking for is, what are your collections in April, May, and June? Where are the collections at? And if you've got a property that's performing, then you're going to get a very advantageous loan, because literally 30 days ago, we were looking at properties in contract getting extension financing because the lenders pulled back. Not just pulled back in interest rates, but LTVs. LTVs went up to 65% LTVs, looking for, huge escrow deposits. They were looking for 18 months of principal, interest, taxes to be escrowed for that property, and then huge liquidity requirements as well. So here is a buyer thinking he's now going to have to, instead of coming down with 25 to 30%, he's now has to come with 35% to buy the property, plus put another 20% in escrow. And it was just putting kibosh on a lot of deals. So we had, personally, my team had 3 deals in contract going into COVID. One went to a lawsuit 7 days before closing, and the buyer was citing force majeure. it didn't hold up. The buyer ended up having to close the deal and ended up paying a little bit more for the property. The seller went to lawsuit. We rectified that and got it done. The other two properties had to have extensions to the financing, and now we're starting to see lenders open up. Like Ryan said, more products are becoming available every day in commercial lending as well. So now we're starting to see the 70% LTVs. We're starting to see the lack of need for the escrows and things like that. But it really is all tied to performance of the property. And I deal in a lot of Class C and a Class B properties. I don't sell a lot of Class A's. In the Class C and Class B market, we're seeing 90% plus collection ratios. As in the Class A's, they're seeing 80%.
Daniel, tell people the difference between Class A and B and C, just for those people
Okay.
on that don't really understand the commercial division.
Class A properties you're going to see is the Camdens, a Fairfield residential, Equity residential, 200-300 unit properties that have a ton of amenities, newer construction. You know, that's where you're going to be paying in South Florida $1,800 to $2,200 for a one-bedroom apartment. Whereas Class B and C, you're looking at 1970s built products, sometimes 1960s, all the way up to 1980s. It's a lower quality product that it's a little bit older, and the profile of the tenants are more blue collar working class. So those tenants are still paying the rent in the 90+ percentile, whereas the Class A's are down to 80%. And you know, maybe there's a lot of contributing factors to that. So if you're an investor out there and you're looking to invest in South Florida, definitely target those Class C and Class B assets. You know, the 50 unit apartment buildings and under are still getting a lot of attention. There's very little inventory in the marketplace, but if you keep your eyes on the ball, you're going to start seeing a lot more opportunity come out. But again, it's all tied to the performance of the property. And that ties right back to the current owner of the property. Is he communicating with the tenants? Is he working with the tenants? Is he, you know, knocking on the doors? Is he saying, hey, here's how we can help? You know, a lot of landlords have been using certain strategies to keep their tenants paying and keep the money coming in, i.e. using their last month's rent as rent, using their security deposits as rent, modifying their leases, and keeping the tenants in the unit, because you can't evict the residential tenants right now. No matter what they do, you can't evict them. And they're talking about extending that into August. So, but luckily, like I said, a lot of Class C property owners aren't having that problem. They're very open with communication with their tenants. So
Could you go ahead and would you repeat again the collection percentage for Class A versus Class B, C?
The National Multi-Housing Council did a survey of 11.5 million units nationwide. And they found in the month of May that those collections were around 80.4%. And coming into June, they're up to like 82%. Those are Class A buildings. Those are the easiest ones to survey. Class C buildings are coming from my point of view of talking to hundreds of investors that own properties here in South Florida. I'm seeing in the low to mid 90s percentile collections. So those Class C tenants that are working class blue collar people, they're paying the rent more often and more likely than the Class A tenants. So I think those assets are going to hold their value a lot more here down South Florida. And again, if you can show a lender that you're collecting those rents and you're showing April, May, and June collections are in the 80s and 90s, you're going to get a very favorable loan. And that ties again right back to the owner of the property. Is he proactive with the tenants? Is he making sure that they can pay? Is he communicating with them?
Yeah. That's
really the key. The quality of the landlord, how they're managing, has a lot to do with their collections right now. A lot.
I bet. How does the cap rate impact COVID? Is South Florida still in the 3 to 5% cap?
Well, now you're looking at Class A properties. I mean,
right.
I didn't see 3 cap properties even in Class A went in the run up here in 2018, 19. I didn't see that. I was seeing high 4s because you can get financing in the mid to low 3s back then. Now, financing for a commercial property has moved to around high 3s. You know, in the middle of COVID, it was 4.5, 4.25. And now you're getting below 4%. So now it's starting to open up the window for buyers to come down and put down 30% and get a favorable interest rate. So cap rates down here for Class C. If you can acquire something that's at a stabilized current 6 cap when the taxes and the insurance have been upgraded to current, and that there's upside in that, that's a good deal. You should get it.
Okay, great. All right. Do you have anything else, Daniel, that you want to talk about? Looks like I got a couple of more. Do you think that, hang on, they're coming in now. Do you
Bring 'em
think
on.
that C-class performance is due to some of the government assistance, unemployment, and the one-time checks?
Absolutely. I've literally had conversations with the landlords that own properties in even sometimes very dangerous neighborhoods, all the way to, mid markets, saying that their opinion is some of my tenants are getting a raise. And not to mention just the rents are being paid, but multiple property owners that own properties, portfolios across Broward, Palm Beach, and Miami-Dade County, they're experiencing a lot of lease starts. So when they had vacant units going into COVID, those units are getting leased up very quickly, which is the opposite of what we expected. We expected to be a lot of high vacancy, people not moving, but it's not the case. It's not what we're finding in the Class C and Class B properties. We're seeing a lot of velocity in lease starts. People leasing up their units very quickly, and they're getting, in some cases, higher rents than they thought they were going to get, if they're advertising their units and it's out there.
Interesting. What is the Class C cap rate?
Right now, again, if you can get a Class C cap, all depends on the neighborhood and the location. Obviously, that's location dependent. If you're looking closer to the ocean, the beach, where you can, get a little bit more equity growth after the purchase of the property, you can get sub-6 cap going in, and maybe even closer to 5 cap. Recent properties have traded in Boca Raton for right around a 5 cap. Those have pro forma opportunities. The big business plan down here in the last 5 years in South Florida has really been people acquiring Class C properties and giving them Class B to Class A upgrades, and acquiring those tenants that, quite frankly, they're not going to pay $2,200 for a 1-bedroom, but they'll give you 14 or 15 for an upgraded Class C property, giving you those same renovations, the granite countertops, the vinyl planking flooring. They might not have the amenity package, but they have a lot of those upgrades that these tenants want. So you're capturing a tenant that is caught in between, and those tenants typically have very good jobs.
Concerning the eviction laws, do they apply if you own the property without a mortgage?
Oh yes, that's part of the problem. We have landlords that went into COVID, and even in the middle of an eviction before COVID happened, those tenants are now still there. That's the problem. That if you're an investor and you really want to acquire multifamily property, and you're going to contract with a particular loan contingency, the first thing you need to get is a delinquency report. You want to know how many tenants are not paying and how far they're behind, how many are under eviction. You can start eviction proceedings in the middle of this pandemic. You just can't actually evict them. You can start the proceedings. You can give them the 3 and 10 day notice. You can let the tenant know they will be evicted. You just can't kick them out. That's the problem. They can sit there until DeSantis tells them they can't have to leave. And that's going to be a problem.
All right, great. Well, I think I got all the questions. Did you have anything else you wanted to add? Or Ryan, do you have anything to add that you might want to mention? Just thought I'd check in with you to see, because he did talk about some of the lending things.
Yeah, the commercial side is a little bit outside of what we do here at Cross Country Mortgage. We're just more on the residential.
Oh, the residential investment side. Okay, cool.
I will say one more thing on the lending environment. In commercial, the tectonic plates of the lending environment shift constantly. Some lenders, and the perspective is every lender has a bucket of money they need to put out in the marketplace. As that bucket gets spent and lower, they're going to start raising their spreads and raising their interest rates. So it's very, very good idea for somebody to have somebody that's in touch with all the most aggressive debt in the marketplace. Because again, that tectonic plates shift as the market goes. Right now, there's a lot of lenders out there that need to put money on the streets, and they've been very cautious over the last 4 months. Now they're going to start opening the floodgates as they see properties are performing. It's very important for you to have somebody that's in touch with that mortgage environment and the lending environment, and accessing those lenders that are the most aggressive in the commercial realm. So definitely have yourself a mortgage broker that's in touch with those lenders. On my team, I have 2 guys that all they do is commercial loans. Any residential business loans that I get, I actually send them to Ryan. Ryan financed my house when I bought a house in January. So he's the best there is when it comes to residential. And so,
Well, and I know Ryan does investment rental properties and that kind of thing also, which we have a lot of condos and lots of single family rentals in the state of Florida. Looks like we had one more question come in. It's making me smile. Does the eviction laws pertain to commercial properties also?
no, that if you have a tenant in a strip center or an office building that's not paying, you can't evict them. You can go right through the same eviction proceedings, but expect a delay in that eviction because the courts are backed up. Sometimes sheriff officers aren't going to come out. So it's a different process, but yes, under Florida law, you're not going to be able to evict them, but expect delays.
Yeah. All right. Very good. Well, thank you very much, Daniel. That's very informative. And for our last guest today, it's Charles Esposito, who's the managing attorney at JK Closing Attorneys. Charles focuses solely on real estate closings. Charles, if you could just tie all this together for us, what are you doing to keep business moving forward?
Hi, everybody. First, I just want to thank Janet, and Teresa, and Brenda for putting this on for us because, we've been doing a lot of different Zoom chats. I have been with realtors, brokers, and clients that we work with. And Midland 1031 is the company that I always refer to for 1031 exchanges. And I really appreciate them putting this together for everybody and getting all this great information out to not just our clients, but their clients and Daniel's clients and Ryan's as well, and everybody else who's listening too. So thank you so much. As far as, what we've been doing, I kind of wanted to talk a little bit about force majeure and how that affected us during the COVID pandemic. There are a lot of people who think maybe there's going to be a second wave or something like that. So if we have to shut down again, how does that affect real estate transactions? From our end, with doing a real estate transaction, whether it's residential or commercial, we actually didn't have too many force majeure situations. There's a lot of different technologies that are available now to do a real estate transaction. And depending on the underwriter that you're using for title insurance and depending on the lender that you have, it might be a possibility where you could do a remote online notary, and depending on what state you're in as well. So Florida, for instance, just passed a remote online notary law last year that went into effect January 1st. So remote online notary is available for a lot of different transactions. But then the caveat to that is whether or not your underwriter is going to accept a deed that is remotely notarized. So one of the underwriters that we work with, Westport, they do accept that. So when we do a real estate transaction where we're issuing title insurance, it can be a completely remote online notarization closing. And there are several other underwriters that do it. There are a lot of underwriters that don't do it because they're unfamiliar with it or they're unwilling to accept what the companies do. Remote notary is pretty similar to what we're doing right now. A notary is on the other side of a camera. They're talking to the client. They see their driver's license or passport, and then they will notarize a document electronically. And if that person needs to have witnesses with them, they'll have witnesses in the room with them as well. Remote online notary has some caveats to it. So for instance, if you have a seller that is Canadian or international and they need to do a remote online notary, the option is unavailable to them because you need to have a United States Social Security number so they can do a background check on you. So most companies do a quick 3-question ask, have you ever been associated with this address before? Did you own a 2005 BMW in the past? Things like that. And the client needs to answer that to verify who they are. So if you can't do a remote online notary, there's a ton of notaries that will go to houses and things like that. So that's been the big concern for a lot of people was how are we going to get a closing done? And realistically, most transactions were able to happen absolutely fine without any sort of force majeure. One of the issues we had was people in Canada, when they were on lockdown, they couldn't have anyone come to their house and they couldn't leave their house to be able to sign anything, and they weren't able to do a remote online notary. So we had a couple of closings with Canadian sellers that we all agreed that it might be a force majeure situation. Rather than let it be litigated, we just extended the contract, and once they were able to get out and do a signing, they did it. The National Notary Association has relaxed some of their notarial standards. We've done a few of what we call drive-by closings, where we drive up to somebody, we hand them documents, we watch them sign them, and then they hand the documents back to us. Or there's also porch closings where we did them outside, social distancing, masks. So the point of this is, I think Daniel touched on it a little bit too. We had a bunch of people right when COVID hit said, oh, we can't close, force majeure. And when those, a lot of times it was buyers who were trying to back out of the contract, they came to my office asking for legal advice. And I said, well, what's preventing the closing? And the answer was always, well, we lost money in the stock market, or, it was difficult to sign a document. If it was from the seller side, they didn't want to let somebody into their home to do an inspection or an appraisal or something like that. Those were not things that were adequate to rise to the level of a force majeure, because a force majeure has to actually prevent the closing from occurring. So in the past, a force majeure might be if a hurricane hit Florida, power went out all across the state, and my office was unable to conduct a closing, either electronically or in person, because there was no power. We couldn't print anything. Now, if something like that happens, we probably could go to a virtual office on the other side of the state, if it didn't affect the whole state, and still conduct the closing that way. We do remote closings all the time. So there was very, very little that actually prevented our office from doing the closing due to COVID. There were a ton of legacy companies, law firms, title companies that couldn't perform closings because they didn't have the capabilities of doing it. But that didn't necessarily mean that there was a force majeure preventing the closing. It just meant that their office couldn't handle it. Similarly, with lenders, when they pulled back funding, whether it was commercial or residential, somebody lost their job, something like that. If they did that and there was no addendum to the contract that allowed the buyer to extend the closing, if something like that happened, then that's not a force majeure situation. That's a decision by the lender to, withhold funding, or, perhaps if a buyer lost a job, it is due to COVID, but if it's after the loan approval period, it's not a force majeure situation. And some of those people were just out of luck. The Florida Realtors Association has a few addendums that were floating around about COVID. If I'm representing a seller, I didn't let any of my sellers sign those COVID addendums because it gave the buyer another free out to the contract. But on the flip side of that, the sellers were very, very accommodating in most situations to extend closing dates, because they also felt, from the seller's perspective, that if they lost a buyer or a buyer defaulted, it was going to be very difficult for them to find another buyer while COVID was happening. And so it's taken about 45 days, but we're starting to see the market pick up. A couple of transactions that we had that were on hold, either because of financing or because of difficult situations, have now resumed. Like Daniel said, a couple of commercial transactions where the buyer tried to back out and cited force majeure. The buyer lost on those. There's a couple that we have that are in litigation right now. I don't litigate. But the attorneys that I refer to, if they're representing the buyer, they don't have great cases. So we're working on trying to get those cases, those buyers funded so they can actually close without losing their deposits or having to expend money just to buy themselves out of the contract, essentially. As far as how the market is kind of rebounding from this now, prior to COVID, we'd seen at the end of 2019 an enormous influx of people moving down to Florida and investors moving into Florida because of the 2017 tax reform bill. So the 2017 tax reform bill reduced or capped out the SALT tax deductions for that's a state and local tax deduction. It was capped at $10,000, and many states in the Northeast, in particular, investors and high-income earners were affected by this, so they can no longer deduct their state and local taxes. So they started to look for states where they can have better tax advantages. States like Florida, Texas, South Dakota. And Florida saw an enormous influx of people from Northeast, New York, Connecticut, New Jersey area coming down, and some people taking early retirements to move down here, other people moving their investment properties from up north to down here because the tax advantages were just so great. So we saw a huge uptick at the end of 2019 where normally our busy season might be July, August. That carried all the way through the last quarter of 2019 and into the first quarter of 2020. And then as soon as COVID hit in the beginning of March, that's where we started to see a little bit of a drop off. But now that the restrictions are being lifted, we're starting to see those numbers pick up again. My file count in my office is increasing. Other people in the industry that I talked to said that their phones are starting to ring now, and their file count is going up. And in addition to people still taking advantage of the tax haven that is Florida or Texas or these other zero income tax states, now we're seeing people are also using COVID as an excuse to move out of some of these states that were affected in much greater numbers than maybe Florida or Texas, California. It seems like warm weather has something to do with this, whether that's just anecdotal or whether, a correlation versus causation. People are perceiving it that way. And so if the tax excuse wasn't enough before, the lockdowns and the threat of pandemic are now. So Florida is seeing an uptick in rentals, seeing an uptick in residential purchases, and then also an uptick in commercial purchases as well. And one of the things that COVID has done, like we were talking about with real estate closings, moving online and being able to do things remotely, people are now realizing that they can work remotely. So in some cases, people were being forced to stay home, and I had a lot of commercial clients who were concerned. Maybe they had office space and they were losing clients because they were no longer going to renew their leases. But what I found is that some people that found that their whole business could be remote from anywhere, that didn't mean that they had to stay home and work. It could mean that they're moving from New York to Florida and opening up an office in Florida. And we had a hedge fund that's actually purchasing a property down in Miami right now. Their motto is they like to put the fun in hedge fund. And they realized that their clients didn't care whether or not they were in the tri-state area to be around, the markets in New York. So they're going to relocate down to Miami, and they're going to look for some sort of residential office space, they're currently under contract for that. And I thought that was really interesting, that COVID is kind of foisting this technological advancement in real estate closings, and it's allowing people to make decisions faster than they would have. People that are moving out of other states or working remotely just now have more options because it's acceptable for you to work from home or work remotely. On the residential side, I had a friend that lived in Connecticut. They worked for Yale New Haven Hospital, and they were sent home to work remotely. They had been talking about moving and relocating to Texas for a couple of years, and they took the opportunity to just move to Texas. And so she works at Yale New Haven Hospital from Texas. And, eventually she'll probably find a different job in Texas, but they were able to do that. And they essentially killed two birds with one stone. They changed their tax situation, and they also were able to move to a warm weather state like they wanted to. And they probably wouldn't have done that without this pandemic. So there's a lot of different opportunities that are cropping up because of this. It's not all bad news. Some of it is good news. Certainly in states like Florida and Texas, it's good news for the market. We've all been assuming that Florida was going to bounce right back, just kind of anecdotally between office discussion and brokers and realtors that I work with. And in the last 3 weeks, I'd say our file count is upticking, and we are seeing a bounce back. So like Ryan was saying, everybody was refinancing before. Everybody's still refinancing. The rates are super low on the residential side. Commercial side, the rates are starting to go back down again. Lenders are more comfortable lending because they're seeing that maybe valuation of properties was stable during COVID. And I think in Florida in particular, that's going to continue to occur. And, we're looking forward to finishing off 2020, hitting record high numbers again, as we started to do at the beginning of the year. So that's kind of my perspective on this. If anybody has any questions, please let me know. And I don't know, Janet, if there's any questions.
I don't really see anything. You did a good job covering everything. What about Ryan or Daniel? Do you all have anything you want to add at this point? Brenda, do you want to put everyone up if you can for me?
Realm of commercial real estate, in multifamily, I think if you're looking at anything in commercial real estate for large investments, multifamily is going to be the one product type that the government really has supported more than anything else through the unemployment numbers and the things like that. Those are the tenants that are getting the most, I guess, the most benefit from the government. So multifamily is doing very well still, very well.
I have a question for you, Dan.
Yeah.
Dan, are you seeing have any of your larger tenants started to request any downsizing in space? Are you seeing companies looking to either downsize as far, now that we're finding a lot of companies are moving operations off-site?
Well, you're asking me, correct?
Yeah.
We're starting to see, like, as far as my company, Marcus and Millichap, they've actually done some downsizing because they've realized that some of the employees can work from home. And although I'm back in the office, I would say literally half of my office is still working from home. So, I mean, I haven't seen a lot of my clients. Again, most of my clients own large multifamily homes. They don't own, office space or commercial space, but some of the clients that do cross-pollinate between the product types, i.e. people that own office buildings and multifamily, they're seeing some serious dip in rent collections in their office buildings and in their retail centers. A serious dip in collections. Yeah.
All right. I don't see any other questions. Mike, I see a question about 1031s, and I'll answer you separately at another time. I really appreciate your time, you all. Thanks to everyone for joining. I'm going to put up the slide here at the end that has everybody's contact information. And are you guys okay with, I did just see a question come really quick, so never mind. Let me stop a minute. Any outlook for the assisted living space?
I can take that. I've sold several assisted living facilities. Some were maintained as assisted living facilities. The most recent was a 320 unit property in West Palm Beach that was assisted living converted to multifamily. I think assisted living, I think you're going to get a huge uptick in assisted living. I have a couple of owners that own a lot of assisted living properties, and they're expecting quite a boom down here in Florida. And I think it was touched on the massive influx of people from the Northeast. People were already migrating. The capital migration from New York and from California over to Florida was already exceeding expectations at the beginning of the end of last year. Now I think you're going to see it really blow up. You're going to see a lot of capital migration coming down here. You're going to see a lot of retirees coming back down to Florida. They don't want to live in the cold weather. They don't want to shovel snow anymore. They're tired of the taxes, and they dang sure don't want to be locked down anymore. So you're going to see a lot of influx. I can tell you that one of my friends sells a lot of single family homes and condos in places like Century Village. And their real estate office in a West Palm Beach, there's a Century Village. The real estate office there is out of control. They're running around like chickens with their heads cut off.
Really?
So there's so many people that want to move in and want to buy.
That's interesting. I was listening to a report today that was about people, because of COVID and all the assisted living and where a lot of that occurred, that people might be leaving and fleeing that. So that's an interesting perspective to hear that people might be fleeing from maybe other parts of the country, but still coming down here to assisted living.
Right. And just to comment on that too, Florida's laws regarding that during COVID were completely different than other states' laws. So it is going to be regional and it's going to be state specific for certain things too. So Florida has a really advantageous environment for all types of real estate, and in particular for assisted living. I mean, our state just handled assisted living facilities differently than, say, New York or Pennsylvania, something like that. So now the market is going to reap the benefits of that.
And I believe Rick asked that question. I think that was a really good question, Rick, and that nobody else even thought of, because that's like when the downturn hit in 2009, 2010, 2008, the one product type that took a huge jump was self-storage, because people were downsizing, moving their furniture into storage and moving in with mom and dad. I think the big next pop is going to be assisted living down here in South Florida. I think it's a great question. It's something that I hadn't even really thought of until you brought it up. So that's a product type that I think people should keep their eyes on down here.
Interesting. All right. Any other questions before we go? Okay. Well, thank you guys very much for your time and your knowledge. And I'm going to share my screen here at the end and put up their contact information. And I'm sure they won't mind if you gave them a call or shot them a. Let's see here if I can get this going. All right. Here you go for everyone. So thanks everyone for joining. We'll see you next time and have a great evening. Thank you.
Thank you.
Thanks for coming.
Thanks, Janet. Bye, guys. Thank you.
Bye.